Hello, everyone. So this is the third subtopic under Part 1, Section E of the CMA syllabus, particularly on internal controls. So this third subtopic will be all about corporate governance and external audit requirements. So first, let's talk about corporate governance. Now, before we fully understand what is corporate governance, let's define first what is governance. So governance is the process of decision making and the process by which these decisions are implemented or not implemented, depending on the final decision, through the exercise of power or authority by leaders of the country and or organizations. So governance as a general term applies not only to corporate entities, but also to government as well. So if we talk about governance or governance, this is actually about the process of decision making and then finally coming up with a decision whether or not to implement or not to implement a particular matter. So to apply this within the confines of corporate entities, we will now define what is corporate governance. So corporate governance includes all of the means by which businesses are directed and controlled. So directed and controlled, including the rules, regulations, processes, customs, policies, procedures, institutions, and laws that affect the way the business is administered. So corporate governance spells out the rules and procedures to be followed in making decisions for the corporation. So from the general definition of governance, we can now apply it to a corporate setting. So it's about decision making, but this time only for matters that are relevant to the corporation. So corporate governance is the joint responsibility of the board of directors and management. So at this point, we have to be clear that when we speak of board of directors, it is not the same with management and vice versa. So these two groups are different. The board of directors is one group and another group is the management. So if we talk about board of directors, we are talking about the chairman of the board. No, that the board of directors is headed by a chairman of the board, and then we have members of the board, or we call them directors or members of the board. And then if we talk about management, the head of the management team is what we call the president. So technically, the president is different from chairman of the board. But normally in a corporate setting, sometimes the person that is the chairman of the board is also appointed as the president. So sometimes we refer to it collectively as president and chairman of the board. But technically, these two persons are different in a sense that they are heading a separate group. So chairman of the board is the head of the board of directors, while president is the head of the management team. So corporate governance is the joint responsibility of these two groups. The first group being the board of directors and the second group being the management. Corporate governance also involves the relationships among the various participants and stakeholders in the corporation, such as your board of directors, shareholders, your CEO, and the managers. Now, corporate governance is very concerned with what is known as the agency problem. So what are these agency problems? These agency issues arise from the fact that the owners of the corporation, which we call shareholders, if the corporation is a stock corporation, we all know that in our study of financial accounting. So the owners of a stock corporation is known as stockholder or shareholders. as well as the managers of the corporation, or we call them the agents of the shareholders. These two are different people. So for example, if we have a closed stock corporation, when we speak of closed, closed with D has a closed stock corporation, this means that the shareholders are very much limited. So around 10. So only 10 shareholders. But it could be that these 10 shareholders are not the same persons as the managers of the respective departments inside the corporation. So kaning mga managers, these are mere employees. And as employees, they are considered as agents of the owners or agents of the shareholders. So these two are different people. The priorities and concerns of the managers are different from the priorities and concerns of the shareholders. Why is that? The managers are concerned with what will benefit them personally. So since the managers, as I have mentioned, are mere employees, so unsa may concern sa employees? Ang concern lang sa employees, ang main concern nila is their benefits, right? So for example, their increased salary, bonuses, their power to control some parts of the organization, and the prestige as well, being the manager. The shareholders naman, their priorities lie with seeing the value of their investments in the corporation increase. So lahi ang ilahang main concern. So the manager's concern are more on the benefits that they will receive as employees, while the priorities or the focus of the shareholders as owners is particularly the increase of the value of their investments. So the priorities of the shareholders and the priorities of the managers can easily be in conflict with one another because what benefits the managers may not benefit the owners, right? So therefore, corporate governance specifies the distribution of rights and responsibilities among the various parties with conflicting priorities and concerns in an effort to mitigate the agency problem and bring about congruence between the goals of the shareholders and goals of the agents or the managers. So again, seeing that the priorities of both groups, no, kaning shareholders or slash owners and the managers slash agents are in conflict with each other, corporate governance comes into the picture in order to mitigate this so-called conflict, in order to harmonize their priorities. So incentives are needed, so the agents will take actions that are consistent with shareholders' benefit. At the same time, however, monitoring mechanisms are needed to control any activities of the agents that would benefit them while hurting the shareholders. So for example, head of the purchasing department. The head of the purchasing department is in charge for the, let's say, the canvassing of prospective vendors or suppliers. So in looking out for the best suppliers out there for the company, dapat tanaw niya ang quality and reputation of the supplier. But what if naiisa ka potential or prospective supplier nga ni-offer og rebates or hatagan daw og commission si head of the purchasing department if adto ta mo palit niya. So because of that, naganahan si purchasing department head or manager niya dito siya ni palit from that supplier para makakuha siya og commission, when in fact there is a better supplier. So that would actually hurt the shareholders financially. For example, another example, management compensation policies that tie managers' bonuses to stock price increases can lead to actions on the part of management that will cause the stock price to increase and will thus be good to all shareholders. However, so this type of policy that I have mentioned, this is a good implementation of corporate governance, because in this case, the priorities of the managers and the priorities of the owners or shareholders are now in line with each other. However, if managers try to conceal poor financial performance in an effort to keep the stock price going up so their own bonuses remain intact, those same incentives can lead to fraudulent financial reporting, which obviously is not good for the shareholders or any other stakeholders. So prevention of unintended consequences such as fraudulent financial reporting is the responsibility of the board of directors and should be implemented through internal controls. So diri na sad mosud ang role ni internal controls. So in order for us to mitigate or make sure that no fraudulent financial reporting is being done by our managers and agents, we can implement internal controls through for example, through our software applications that we install wherein the transactions are being encoded. So magbuhat ta dito, magbutang ta og mga internal controls that would prevent this from happening. So what then is the purpose of corporate governance? The purpose of corporate governance is to facilitate effective entrepreneurial and prudent management that can deliver long-term success of the company. So in simple terms, the fundamental aim or purpose of corporate governance is to enhance shareholders' value as well as protect the interest of other stakeholders by improving the corporate performance and accountability. So it is also about what the board of directors of a company does, how it sets the values of the business firm. So when can we say that our current corporate governance is good? So what are the characteristics of good governance? So good governance should have the following. So we have participation, accountability, effectiveness and efficiency, equity and inclusiveness, consensus-oriented, responsiveness, transparency, and rule of law. Let's look at these characteristics one by one. So first characteristic of good governance is participation. Participation by both men and women is a key cornerstone of good governance. So participation could be either direct participation or indirect through legitimate institutions or representatives. It is important to point out that representative democracy does not necessarily mean that the concern of the most vulnerable in society would not be taken into consideration in decision making. So if you apply this concept, particularly to corporate governance, it means that the voice of the majority is not the only voice that matters. We should also ask for the opinions and inputs of the minority. So, for example, dili lang ang voice ni managers o kanang mga heads and departments ang important. We can also ask the opinions of the rank and file employees. Participation needs to be informed and organized. This means freedom of association and expression on one hand, and an organized civil society on the other hand. If we apply this to a corporate setting, this means that we should encourage our employees to speak up, not to share their opinions. And then we should also address these opinions in an orderly manner. So dapat dili pud-pud. Next, we have rule of law. Okay, rule of law as a characteristic means that good governance requires fair legal frameworks that are enforced impartially. So it also requires full protection of human rights, particularly those of minorities. Impartial enforcement of laws requires an independent judiciary and an impartial and incorruptible police force. So this is governance in general, but if you are to apply this in a corporate setting, this means that good governance requires the issuance of established rules and procedure. What are our corporate policies? So dapat natin established policies. And then these policies should be implemented impartially. So that when we speak of impartial, that means wala tayo gipapuran. If na ay head nga naka-violate sa ato ang policies, they should be punished accordingly. Dili lang kay kaning mga lower rank employees lang ang atong i-punish. So we should enforce our policies and procedures impartially. So kini, it should have an independent judiciary. So if we are to apply this in a corporate setting, that means that we should have an impartial team that would address, for example, mga complaints and issues. So example, our human resource department. So the human resource department should be very independent in addressing mga complaints about the employees. So they should conduct investigation without bias, and then enforce any decision, for example, to terminate or to suspend the erring employee. The enforcement should be also impartial. Next, we have transparency. So transparency means that decisions taken and their enforcement are done in a manner that follows rules and regulations. It means that information is freely available and directly accessible to those who will be affected by such decisions and their enforcement. So for example, if there are significant and major decisions that would affect everyone in the company, the board of directors and the management should see to it that the concerned persons are informed. So most of the time, we do it through email. So mag-send o email blast and naapoy ipang post sa mga bulletin boards. So this promotes transparency so that if the employees would want to know what is happening in the company, what decisions are being made, they can just look at the bulletin board or they can refer to their emails. Then responsiveness. Good governance requires that institutions and processes try to serve the needs of all stakeholders within a reasonable time frame. So if we apply this in a corporate setting, whenever the managers or the board of directors receives a letter or any concerns from our employees or even outside the corporation, let's say nakadawat ta og mga letters from our suppliers or customers, clients, or even the government for compliance and regulation purposes, we should be able to respond to these concerns within a reasonable time frame. So dapat dili siya delayed. So we should be able to respond as soon as possible. Then consensus-oriented. Good governance requires mediation of the different interests in society to reach a broad consensus on what is the best interest of the whole community and how this can be achieved. So if we are to apply this in a corporate setting, we should be able to harmonize all interests of all persons involved. Dapat wala kay gipaboran nga interest na interest lang sa managers o niya bahala na ng mga rank and file employees. So that should not be the case. We should be able to come up with a consensus nga kitang tanan maka-benefit, kitang tanan ma-happy. No? So best interest of the whole. And then we have equity and inclusiveness. This ensures that all its members feel that they have a stake in it and do not feel excluded from the mainstream of society. So this requires all groups, but particularly the most vulnerable, they should have opportunities to improve or maintain their well-being. So if we apply this in a corporation, the rank and file employees should be able to feel that their concerns are being taken into account, that their benefits are also taken into account. Wala sila echapuera, wala sila kalimutan. So this reflects equity and inclusiveness. If we want to promote good corporate governance, we should be able to apply this characteristic. We should have this characteristic. We should include everyone. We should not exclude anyone. And then last characteristic of good governance is accountability. Accountability is a key requirement of good governance. Not only governmental institutions, but also the private sector and civil society organizations must be accountable to the public and to their institutional stakeholders. So when we speak of accountability, this means that certain persons have specific responsibilities, and if they commit any errors, or if there are problems that have occurred within their sphere of responsibility, they should be able to own their mistakes and be held accountable. So whatever the consequences are, they should be able to accept it, and these accountability spot should also be in line with the established rules and procedures of the corporation. So what are the objectives of corporate governance? So we have here 4 main objectives. So the first objective is to have fair and equitable treatment of shareholders. And then the second objective is self-assessment. So this enables firms to assess their behavior and actions before they are scrutinized by regulatory agencies. So corporate governance is there in order for the corporation to have a self-assessment. Dapat at first hand, kabaw na sila, asa sila nasayop, asa ang mga parts ang kailangan i-rectify before they could be punished by outside regulators. Corporate governance is also there to increase shareholders' wealth, and this is the most important objective of corporate governance, as we have mentioned a while ago when we discussed the purpose of corporate governance. And then the last objective is transparency and full disclosure, which we also addressed when we discussed the characteristics of good governance. So, who are the parties involved in corporate governance and what are their respective responsibilities? So, a while ago, I mentioned that corporate governance is a joint responsibility of the board of directors and the management. So, that is in general. But in reality, who are the parties that are actually involved in corporate governance and what are their roles? Nganong involvement sila sa man ilahang role di ay sa corporate governance? So, we have here 9 parties. First is the shareholders. So the responsibility of the shareholders is to provide effective oversight through the election of board members. So the members of the board of directors are actually elected by our shareholders. And the shareholders also perform the approval of major initiatives such as buying or selling stock, annual reports, and management compensation from the board. So not all decisions of the corporation are being decided by the board of directors only. So there, in your study of corporation law, you have learned that there are some decisions that need the consensus or the vote of the shareholders and not just the board of directors. So for example, the increase of the let's say the decision to increase the authorized capital stock, we need the majority vote of the board of directors as well as the vote of the shareholders. Another party involved in corporate governance is the board of directors. So the responsibility is that they should ensure that the organization is run according to the organization's charter and there is proper accountability. So, kaning organization's charter, this is a collective term for the corporation's articles of incorporation and the bylaws. Okay. And then another party is the non-executive or independent directors. So they perform the same role as that of the number 2 nga board of directors. Now, independent directors, dili na siya always naa. So, independent directors are only required by the SEC or Securities and Exchange Commission for public corporations. So, kaning public corporations, dili ni pasabot government corporations ha. Public meaning their stocks are being traded in the stock exchange and they have at least 1,000 shareholders holding at least 100 shares each, or they have an asset of at least 50 million. So kana dako kay siya nga corporation, that's the time that SEC requires the presence of independent directors. But again, not all corporations have independent directors. And then another party that is involved in corporate governance rather is the management. So the rule is on operations and accountability. So main difference po di ay sa board of directors from management is that the board of directors is only for oversight. Dili sila manghilabot sa day-to-day operations. Ang manghilabot sa day-to-day operations is ang atoang management. So they manage the organization effectively. They should provide accurate and timely reports to shareholders and other stakeholders. Another party involved is the audit committees of the board of directors. They should provide oversight of the internal and external audit function and the process of preparing the annual financial statements as well as public reports on internal control. So the audit committee, this is actually a sub-branch of the board of directors. The audit committees report to the board of directors. They do not report to the management. So audit committees should be independent from management. Audit committee will report to the board of directors and not management. Okay. So another party involved in corporate governance are our regulators. This time, the Board of Accountancy. The BOA sets accounting and auditing standards, dictating underlying financial reporting and auditing concepts. The BOA also sets the expectation of audit quality and accounting policy. Another regulator, main regulator for corporations is our Securities and Exchange Commission. The SEC ensures accuracy, timeliness, and fairness of public reporting of financial and other information for public companies. That is why the SEC requires periodic reports to be filed with the SEC. So for example, we have the GIS or the General Information Sheet, and then we are also required to file periodic financial statements to the SEC. And then another party involved are our external auditors. They perform audits of companies' financial statements to ensure that the statements are free from material misstatements, including misstatements that may be due to fraud. And then lastly, we have the internal auditors. They perform audits of companies for compliance with company policies and laws, audits to evaluate efficiency of operations, and periodic evaluation and tests of controls. So for the external auditors, they are more focused on the audit of the financial statements only. However, for internal auditors, mas broad yung ilang scope such that they will also be able to audit the operations. They are not confined to the financial statements. They can audit any aspect of the corporation. Okay, so let's go back here. Okay, so we are now done with corporate governance. Let's now move on to external audit requirements. So the external auditor's responsibilities and reports, we will now know about that. So the audit committee, here, we have the audit committee. The audit committee nominates the independent auditor, and the shareholders ratify the independent auditor's appointment at the annual meeting of the shareholders. So it is the audit committee that will nominate nga kinsa itong ganahan nga external auditor, unsa nga audit firm, and then the shareholders will then ratify the decision of the audit committee. For publicly traded companies, the auditor presents an opinion letter, okay, that is included in the company's annual report and contains the following. Take note that this is only applicable to publicly traded companies. Kaning publicly traded mo to kung gi-mention ganina. So they should have the auditor should give us an opinion letter. So what are the contents of this opinion letter? First, an opinion on whether the financial statements present fairly in all material respects the financial position, results of operations, and cash flows of the company in conformity with the generally accepted accounting principles. So this opinion, the first content, the first content is more on the audit opinion, whether sa man siya unqualified opinion, qualified opinion, adverse opinion, and so on. Another opinion is an opinion on how well the company's management has maintained effective internal control over financial reporting. So here, the second opinion is on the effectivity of the internal controls. Take note that this opinion is not required for companies that are not publicly traded. So if the corporation is not publicly traded, the only opinion required from the auditor is the first one, whether the opinion on whether the financial statements are presented fairly. The auditor's only responsibilities are to express an opinion about the financial statements and to express an opinion about the internal controls of the company in the case of a publicly traded company. In its capacity as auditor, the external auditor has no responsibility to make recommendations. So again, the external auditor has no responsibility to make recommendations or suggestions to the client about the operation of the business. So kaning mga recommendations or suggestions, we can ask this from the internal auditors, not from the external auditors. The external auditor has no responsibility to follow up any audit findings from the previous year. Okay, so you can read this. These two items are just explanations of these two opinions. So first, the financial statement opinion. What could be the opinion of the auditor? So the auditor's opinion may be unqualified, qualified, adverse, or a disclaimer of opinion. So only these four. The title, in fact, when you look at the auditor's opinion, you can see there at the top, marag heading siya. Makita na nimo siya, unsa nga siya nga type of opinion. Unqualified opinion ba siya, qualified, adverse, or disclaimer. So if you are the auditor, how will you decide whether you would issue an unqualified, qualified, or etc. opinion? So these are our guides. Most audit opinions are unqualified. What does it mean kung unqualified? Meaning that the results are clean. So wala kay nakita nga mga sayop, or if naamgay sayop, dili ra siya material, gamay ra siya nga sayop. The auditor expresses the opinion that the financial statements present fairly in all material respects, the financial position, results of operations, and cash flows of the company in conformity with the generally accepted accounting principles. Now, when should the auditor issue a qualified opinion? A qualified opinion contains an exception. So, na siya yung exception, meaning that the financial statements do not present a true and fair picture. So, may okay na siya tanan except this. So kung nagay siya except this, that means qualified ang iyang opinion. The exception is usually not significant enough to cause the financial statements as a whole to be misleading to the point that they should not be used. So meaning when we say qualified, okay man ang financial statements nato. Sakto ra siya except this. So naray isa ka or particular aspect na medyo sayop, but even though sayop siya, it will not affect the overall utility or usability of the financial statements. Usually, a qualified opinion is issued under one of the following conditions. First, the scope of the auditor's opinion was limited or was affected by restrictions. So wala siya nakabuhat sa niyang mga audit procedures. So himo na niya nga exception. Kanang part, the part that was not audited or that was limited, i-appeal na to siya as part of the exception. Another reason for issuing a qualified opinion is that one element of the financial statements, for example, fixed assets baron or inventory, is not stated properly in conformity with GAAP or because of inadequate disclosures. Now, when should the auditor issue an adverse opinion? An adverse opinion is issued when the exceptions are so material that in the auditor's judgment, a qualified opinion is not appropriate. So, mas worse siya sa qualified, no? So, di ba sa qualified, ingo ka dito, naa siya sa'yo, pero dili ra ka siya inana ka dako. So, it means that bisag na sa'yo, pwede rin hapon mo magamit ang financial statements. But here for adverse, ang mga sayop, ang mga exceptions are so significant, so material that would affect the entire utility of the or entire value of the financial statement. So in other words, the financial statements taken as a whole are not presented in conformity with GAAP. So muna siya ang adverse opinions. However, in reality, adverse opinions are seldom used because most companies change their accounting upon the instructions of the auditor. Mayroon si auditor, uy, sayop mo ani, so ilan na dayong i-change. So since ilan mang i-change, dili na mo hatag si auditor og adverse opinion. But if mo insist yun si company, dili mi ana, dili mo tuon ninyo. So that's the time that the auditor can issue an adverse opinion. And then disclaimer. A disclaimer of opinion is used when the auditor has not been able to gather enough information on the financial statements to express an opinion. So kung may kag disclaimer, wa ko kahibaw. Ngayon si auditor, wala ko kahibaw. Di ko kaingon nga sayop, disod ko kaingon nga sakto because kuwang kaayo ang information nga ako ang nagather. Okay? So that's disclaimer of opinion. And then going concern opinions and other modifications, you can read this on your own. But when we speak of going concern, diba? You have learned this in your basic accounting, going concern meaning is the business still able to conduct its operations in the future. So if there are some significant problems that the auditor has found out during the performance of audit procedures that would impair the ability of the company to continue its operations in the future, so not I doubt as to the going concern of the company, the auditor should include an explanatory paragraph following the auditor's opinion. So this is an example of an explanatory paragraph that deals with the going concern issue of the company. So here, the accompanying FS have been prepared, assuming that the company will continue as a going concern. As discussed in note number whatever to the financial statements, the company has suffered recurring losses from operations and has a net capital deficiency that raised substantial doubt about its ability to continue as a going concern. Management's plans in regard to these matters are also described in the note number blah, blah, blah. The financial statements do not include any adjustments that might result from the outcome of this uncertainty. And then another opinion, as mentioned, but this is only applicable to publicly traded corporation, is internal control opinion. So the criteria being used by the external auditor in assessing the company's internal control is the internal control integrated framework issued by COSO. So for this part, for the opinion on the internal control, the independent auditor or the external auditor will include this paragraph in its opinion letter. So in our opinion, the company maintained in all material respects the effective internal control over financial reporting as of date, based on criteria established in internal control integrated framework issued by COSA of the Trade Commission. So next, kay di ba si Audit Committee man ang nag-appoint sa external auditor. So the external auditor is obliged to make reports to the company's Audit Committee of the Board of Directors of a publicly traded company that include the following. So unsa man iyang ipang report ni Audit Committee. The accounting principles being used, all alternative treatments being used, the ramifications of the use of such alternative treatments, the treatment preferred by the public accounting firm, and all other material written communication between the registered public accounting firm and the management of the company. Okay, so that ends the third subtopic, and then proceed now to the next subtopic. Thank you.